Holistic Plan presents Tax Time with Jeff Levine. Let's talk taxes.
Hello everyone, Jeff Levine here, and it is great to be back with you. With our time together today, I thought I'd talk a little bit about QCDs, or Qualified Charitable Distributions. Qualified charitable distributions are one of the most powerful ways for individuals to accomplish their charitable intent or to satisfy their charitable intent while also minimizing taxes. But there are some key rules that individuals should be aware of, and today we're going to cover 5 of them. Rule number 1 that you should be aware of when discussing QCDs is that QCDs can only be made by individuals who are actually 70 and a half or older. Now, not 72, that's a common mistake. Some people think it was pushed back to the RMD age. That wasn't the case. It remains 70 and a half. Also note here that it's not the year in which someone turns 70 and a half. It's the actual age someone reaches age 70 and a half. So if you turn 70 and a half on December 15th of the year, which means you turned 70 earlier that year on June 15th, well, guess what? You cannot make a QCD until December 15th of that year, actual age. So that's rule number 1 we wanted to cover today. Rule number 2 is that these qualified charitable distributions can only be made from IRAs and inherited IRAs. Cannot be made from plan accounts. No 401ks, no 403bs, etc. Now, that doesn't mean you can't use that money to make QCDs. It just means you have to add an extra step in between. Notably, first, you have to move that money from whatever plan account it is in to that IRA so that later on you can make a QCD. Rule number 3 that's important to understand is that these are limited to only $100,000 per year. And I say only $100,000, that's a lot of money. But it's not limited to the amount of an individual's RMD. It can satisfy the RMD up to that $100,000 QCD limit, but it's not limited. So a quick example here, if you had an RMD of $10,000, but you were looking to give $12,000 to charity for the year, maybe $1,000 a month, you could use your IRA, provided you are 70 and a half or older, to satisfy that intent. It's not capped by the $10,000. By contrast, if you were just really lucky and had a monster IRA and had a $125,000 RMD, well, there you could only use the $100,000 for a QCD. Anything above and beyond that would not count. So that's the 3rd key rule we want to be aware of. The 4th key rule we want to be aware of here is that the amount you give as a QCD would need to be entirely deductible if it were made with non-qualified funds. What does that mean? Well, simply put, what you give to charity, you cannot get anything back in return. Right? No free tickets to charity. Those free tickets will actually ruin your QCD. They won't qualify as a QCD. So it's important to note that as well. You don't want anything in return. And then finally, our 5th key rule here is that you actually have to tell the CPA or tax preparer that a QCD was done. Because a QCD doesn't get reported to the IRS directly. There's no special code on a 1099-R, for instance, that says, hey, this was a QCD. So if a CPA or other tax professional sees a 1099-R, perhaps for $15,000, and the client gave a $2,000 donation to charity via their IRA that year in a QCD, there's really no way to match that up other than for the client, the individual, to say, hey, $2,000 of that IRA distribution was actually a QCD. So make sure it's coded the right way so that I can minimize my tax liability as much as possible. Now, why is that a great way to minimize your tax liability? Well, there are 2 reasons that is the case. All right? There are 2 reasons that can be the case. First off, a QCD helps to minimize your above-the-line deductions. Helps to minimize your AGI because we don't have to worry about taking a deduction. A charitable contribution is a below the line deduction. So the first thing we note is that by using a QCD and excluding the income altogether from a tax return, it benefits individuals because their AGI is lower. That helps to minimize phase outs on things like various credits and deductions, etc. It also can help to minimize things like Medicare Part B premiums, which are not helped by charitable deductions but can be helped by QCDs. The other benefit, of course, is that you don't have to itemize in order to see that benefit, right? A charitable contribution deduction is an itemized deduction, and today, not a lot of people itemize, especially those who are 70 and a half or older. So how could you use this information to help your clients, and where can you spot areas where QCDs can make a real difference in minimizing a client's tax liability? Well, the good news is my friend Ben Birkin is about to show you that using the Holistiplan tool. Thanks so much. We'll see you real soon.
Thank you, Jeff. I'm Ben Birkin, the Vice President of Client Success and Engagement here at Holistiplan. And I want to take what Jeff said about qualified charitable distributions and show you a little bit about how within Holistiplan, you can model something like this for your clients and show them the impact of doing a qualified charitable distribution versus other forms of charitable giving for those eligible folks. So I'm already in Holistiplan. I've got a baseline scenario for my clients here, the appropriately named Robert and Roxanne retiree. Not a lot going on here in terms of complication. There's some investment income. This is their $40,000 required minimum distribution. It's Social Security of about $27,000, a little bit of long and short-term capital gains, but all in all, total income of a little over $101,000 and adjusted gross income of $101,200. What we want to show folks is, let's assume you want to make a $10,000 contribution, charitable contribution. You're eligible to a QCD. You've previously may have written checks to charities. You might have donated appreciated securities to charities. You might have even done donations to a donor advised fund. Doesn't really matter. We're going to show a couple of different options here. The first option might be the actual QCD itself. Now I've already pre-built this scenario within Holistiplan. So I'm going to click on this $10,000 QCD or qualified charitable distribution. And in terms of modeling this in Holistiplan, it's pretty easy. You just take what had been their IRA distribution and knock it down by $10,000, and that's their IRA distribution, right? So we've got our $10,000 QCD, still satisfies our RMD. Net result, just like Jeff said, it's going to reduce our income by $10,000. It's going to reduce our adjusted gross income by $10,000. Not going to show up as an itemized deduction since it never showed up as income in the first place. And we've got a total tax now of $3,550 versus $4,750 if we hadn't done anything. Now you can show clients the impact of doing this one way versus the other within Holistiplan by building an identical scenario and just showing a $10,000 charitable gift. So this is a $10,000 charitable gift, would otherwise be reportable on Schedule A. So everything across here is going to be the same. Now we're back up to an IRA distribution of $40,000. But when we come down to Schedule A, our itemized deductions, in addition to the $20,000 of medical expenses that these folks have, we're also going to give them a $10,000 charitable donation. Now, seems so good so far, right? Except that when you factor in that for these folks, because they're both over age 65, their standard deduction in 2021 is $27,800. There's not enough to itemize. So this $10,000 charitable donation, while well-intentioned, has no real tax impact. They would have taken the same deduction whether they'd given it or not. So you're going to see no difference, or very small differences in the total tax between these two. It's a small difference, but it's there. The last thing, though, that you could potentially show somebody, so the reason why it's different, by the way, we've assumed that they also make a that of their $10,000 donation, 600 of it qualified for the above the line charity deduction. So part of the CARES Act still extends in 2021. So that's why you see it's a little bit different than our baseline scenario, even though the standard deduction is the same. One other last little piece that you could show for somebody who's trying to decide between QCD and charitable donations, the traditional way is, how much would you need to gift before you moved above the itemized limit? Now that is going to be an interesting challenge. I did this through an iterative process and came up with, you would actually need to gift just about $16,000 just to climb above that standard deduction threshold. So that's $6,000 more than the client intentionally wanted to, or originally wanted to give, and that's just for tax purposes. So for this particular client, you can then scroll down, show them, hey, here's the difference if we do it the QCD way versus the way that you're used to doing it. at least in the present year, doing the QCD is going to be the more tax efficient option. Thank you so much for watching, and we hope you enjoy any of the other videos that we have in this series, and we look forward to seeing you use HolistaPlan to be a tax hero for your clients.